Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode takes us inside the world of wealth from the perspective of one of the industry's largest alternative asset managers. We are joined by Sean Connor, the president and CEO, Global Private Wealth at Blue Owl Capital, a firm with over $160 billion in AUM. Sean highlighted a number of key insights for navigating and working with the wealth channel as he shared lessons learned from building a successful private wealth business at a large alternative asset manager. Sean is responsible for bringing the breadth of Blue Owl investment platform to the global private wealth market. He's at the forefront of Blue Owl's private wealth initiatives globally and oversees fund formation, product structure innovation, capital raising, and client servicing. He also oversees business development, marketing, and operations for private wealth at the firm. Prior to his current role, Sean was one of the first employees at Owl Rock, now the direct lending division of Blue Owl, and was responsible for building out the private wealth business. Prior to joining Blue Owl and Owl Rock, Sean served as a managing director at Scion Investment Management for over 10 years. Sean was a member of Scion's investment committee and was responsible for all aspects of Scion's business, including originating, underwriting, negotiating, and corporate finance transactions globally. In 2020, Sean was recognized by Private Debt Investor as one of the industry's rising stars. Sean and I had a fascinating conversation about what it's like to work with the wealth channel. We discussed how and why it's so difficult to work with the wealth channel, why the wealth channel is not a new phenomenon, yet why it's still relatively untapped in terms of alternative asset managers understanding how to work with the wealth channel, how Blue Owl's wealth business works across its 3 different investment platforms, why the wealth channel is not one channel, but rather an agglomeration of different customer types and geographies, how the market is evolving where a one-stop shop type firm may be how much of the wealth channel interacts with private markets, what it means for distribution professionals to understand their client and the daily demands of their business as wealth managers when educating the wealth channel on alternatives products, why education of the wealth channel should focus more on holistic education and less on selling product, and why the wealth channel matters when it comes to alternative asset managers acquiring other alternative asset managers. Thanks, Sean, for coming on the Alt Goes Mainstream podcast to share such actionable and thoughtful insights on how firms can work with wealth.
We're going mainstream.
Sean, welcome to the Alt Goes Mainstream podcast.
Thank you for having me. Good to see you.
Likewise, good to see you as well, and a pleasure to have you on the show. I think what you've done in your career prior to Blue Owl, but then also at Blue Owl, is fascinating when it comes to the perspective of engaging the wealth community in alternatives. We'd love to hear your thoughts on the evolution of working with the wealth channel over time, kind of in the arc of your own career trajectory.
Yeah, it wasn't something I set out to be in from the beginning. Like probably most careers, you sort of feel your way through it. I started more on the investing side in the credit space, did that for many years, 10, 12 years. And at one point, I was helping build and run one of the very, very first versions in the US of these open-ended, non-traded products in the credit space. Those were distributed to a segment of the wealth channel in the US, help build the product, help run the product day in and day out. Got to make all the mistakes, learn a lot of things. I did that from about 2012 till about 2015 when I left. And then I joined what was then Owl Rock. Today, it's the credit arm of Blue Owl. But certainly the sort of arc of being more investments focused, product structure focused, portfolio management focused, and then leaving to join Owl Rock / Blue Owl to help build the wealth strategy. I was coming at it not so much from the sales side, but from all the other angles. It's been phenomenal evolution, and it's been really interesting to see the adoption that's happened and the innovations that have happened. And I think to a certain extent, like any good career, you get a little bit lucky getting into the right space at the right time. And I was early in it and enjoyed it, and I've learned a lot from it, and still think we have a lot to go.
Did you have a sense when you were starting to work in the wealth channel that this was going to be something that would be big?
To start, not really. The firm I was working with was raising capital already in a smaller subset of the wealth space. I don't think there was ever an aha moment for me in particular, but certainly there was moments in time where you sort of look at it and say, well, geez, it's a massive industry. It's really underserved or poorly served. And in either case, those are good things for someone to come in and disrupt. I became increasingly bullish on it. Met Doug, the co-CEO of Blue Owl. He was fired up about it as well, and it really resonated with me. I became convinced that there was a big opportunity for someone to do it differently, improve the experience, improve cost, improve transparency, all of that stuff, and that the market was just too big to not have success if you were able to get some of those things right.
There's a lot to unpack in what you said, particularly the latter part of what you said around the wealth channel having all these different nuances to it. Before we get to that, what was it like working in the wealth channel early on?
A lot of what happened, at least in my career, was people were looking at these non-traded REITs in particular. That was really the first foray into what is today a much bigger open-ended product. So there's really two things. There was either the non-traded REITs, or some managers were just creating feeders and putting them through distribution platforms. I spent more time initially in that non-traded space, and it was very high cost upfront, high cost on an ongoing basis. In many cases, really sub-quality managers or good quality managers giving their B assets to what they viewed as their B clients, all of which meant bad experiences for people. High cost, low quality assets or low quality managers really made it a difficult environment. Or it was good quality products, but just not structured for the wealth space and good quality managers. And it made it very cumbersome and only available for the very select few clients that could figure it out. I would say it was expensive and clunky. And a lot of that has changed over the last few years.
Why has that changed?
Look, it's a massive market. People say wealth as if it's one thing. It's actually a collection of markets. And I'm sure you're going to ask me about that. But in aggregate, it's enormous. It's growing. And it's underallocated to alts. When you think about an opportunity set from an asset manager like ourselves, those are the things you want to look for, big white space that allow you to add value. Eventually, that was bound to and did attract higher quality managers who put in more resources. There's some regulatory changes that made certain types of products easier to distribute. There was improvements in technology. I don't think there was one silver bullet that solved it all, but as you had people take funds and structures that were out there that worked at their core and tweak them and improve them, overlay that with better resources, better education, lower costs, the experience improved. And then that's sort of a self-fulfilling prophecy. I think that's all a very healthy thing and a good thing. I still think it's quite early, though, in its evolution.
Yeah, there's a lot to unpack there. I think starting with, what do you define as the wealth channel and how do you break it down?
I think everybody has a slightly different answer to that question. For us, the wealth space, we look at it, broadly speaking, as domestic and international. Domestic, you have your traditional, wirehouses, so the UBSs and Morgan Stanleys, Bank of Americas of the world. You have your independent channel, which can be some of the regional banks, independent broker-dealers, and then you have your RIAs, multifamily offices. Those are, broadly speaking, the three kind of domestic-only channels. Then globally, you tend to have more of a private banking model. Now, some of those private banks are also active in the US, but those private banks tend to be more the norm in places like Europe, Middle East, Asia, LATAM. And then there's other pockets like Canada, Australia, for example, that are maybe slightly more close to what the US model is. Each one is a totally different set of circumstances, demands, products, resource needs. We cover all of them at Blue Owl. Well, and you say wealth, it's not just one thing. It's really a collection of lots of different things in lots of different places.
Where I want to go from there, because I think this may also help break down how you think about the wealth channel and approach, like you say, different geographies, different types of clients within the wealth channel and how you structure products for that, is break down Blue Owl for us. There's 3 different business platforms. How do they fit together? And then how does that also loop back in terms of how the wealth business informs how each of those 3 platforms should be evolving their business from an investment perspective?
The Blue Owl platform, we are north of 160 billion of AUM on very rough numbers. Around 80 billion of that is focused on credit, predominantly direct lending. That was the legacy Owl Rock business. That's where I started. We became Blue Owl when we combined with our GP Strategic Capital business. That was the legacy Dyal business that was previously part of Neuberger Berman. That's about 50-ish billion of the AUM. And then our third leg of the stool, so to speak, is our triple net lease real estate business, legacy Oak Street. We acquired that at the end of two. All in, 160 billion, all focused on the private markets, and all has a set of common themes, which are helpful for a variety of different ways, but particularly to wealth. High current income tends to be really focused on reducing volatility for our clients. And importantly, we tend to be a market leader. We're one of the largest players in direct lending. We're the largest in GP Strategic Capital. We're the largest in net lease. So not only do we offer an attractive income proposition, we also are in an area where we're focused and we have a market leading scale that helps us both generate investment opportunities, but also investment returns for our clients. That's very deliberate. It's focused, income oriented, and it allows us to really add value to many of our clients.
How do all these businesses fit together?
As we think about it, as my partner Mark will talk about this, we're in one lane. Now the lane has a bunch of different kind of lanes within it, but we're all focused on the private markets and supporting the growth of the private market. So you think about just the growth in private capital generally, the evolution that we have been really supporting and benefiting from is as they grow, they need financing needs. So if you are a large private equity firm and you need capital to grow your business, make an acquisition, expand into new markets, we can finance you through our GP Strategic Capital business, where we are the clear market leader in terms of size. If you have a financing need at the private company level and you own a lot of real estate, we can do so with a triple net lease sale leaseback, or we can do a loan through our private credit business. The way it ties together is it's supporting one common industry, and that makes us more relevant to them. So if we have more solutions to clients, you're more relevant to those clients, and those clients are massive. It's a multi-trillion-dollar industry. It's one that's growing, and that level of growth and our support there is what's fueling our ability to generate those opportunities for our investors.
You talk about you're supporting this industry that is growing. How much does an investor in Blue Owl products, not necessarily Blue Owl stock, although probably the case too, need to believe in the growth of private markets in order to invest into the products that you have?
Many of them don't look at it from the very largest macro. A lot of times it's more focused on the underlying investment strategy. But even within them, the answer is they do need to understand that, because they'll always ask, okay, well, how big is the strategy? What's the total addressable market? How selective can you be, particularly since our products are very focused on downside protection? You need a high degree of selectivity. And so I think inherently they do need to be bought off that the markets we're going after are large. We have the ability to be selective and generate the types of investment returns and risk that we're telling them. So whether or not they make that leap all the way to big believer in growth in private markets, candidly, it's probably more at the OWL stock level. But I think inherently that is part of the discussion when they think about what the addressable market is for the varying strategies.
Well, it's interesting because where my mind goes when you say that answer, as well as what you said before about being a market leader, is the importance of scale. And I think it was actually your colleagues, Michael Rees and Sean Ward, put out a paper recently from the GP Strategic Capital side about the 24 outlook. And you look across the different asset classes or strategies within private markets, and the top 10 funds raise more than many of the other funds in each category. So it seems like scale matters. What's your view on that in terms of being able to have scale from an investment perspective, how and why that helps you?
I think it depends, of course, on the strategy. I think some strategies are better designed to be more niche, where perhaps the total addressable market is smaller. So by definition, you want to be smaller to be more selective. Certainly for the areas that we focus on, scale is massively important. As a lender, the value proposition, one of them is certainty. You can only provide certainty if you actually have the capital. In addition, one of the attributes we like to offer in our direct lending is protecting our investor capital. One way we do that, we think, is focusing on bigger credit. So if you want to provide certainty of capital to bigger companies, definitionally you need a bigger pool of money to do that. And we are one of the largest players there. GP Strategic Capital, we're taking minority ownership stakes in other private asset managers. Our view is the bigger ones are the more established. The bigger ones tend to garner more market share. They attract better talent, et cetera. The only way you can take a stake in a bigger company is to have more capital. We are the largest player in GP stakes, so it's very important there. And then the triple net lease business, it's not dissimilar to our credit business. It's very different than traditional real estate. We're not buying office buildings and managing them or multifamily or things like that. It's typically a financing solution. And again, it comes back to that certainty. If they want to know that they're going to transact with us, we need to be able to have the capital. We can drive better terms and get better sources of opportunities by being scaled. For us, scale is quite important within our strategies, and those are the types of things that we like to build upon.
I think scale probably is also beneficial as you work with the wealth channel. As they start to enter private markets, I think they probably appreciate working with a firm that has size and scale. From that perspective, you mentioned 3 different business platforms at Blue Owl. How does the wealth business that you run, how does it work with all 3 of those platforms?
The wealth business at Blue Owl, which I run, it really just cuts across all of them. Our goal, our job is we work very closely with my other partners at the firm, and we try to bring our capabilities to the individual investor, period. What's really important to us is making sure that, and a lot of our success in the market has been, we are bringing the same set of investment opportunities we are bringing to who you would consider the traditional institutional investors down to the individual investor community. So our job is not just to simply raise capital. We're really trying to build a business where we are getting access to a bigger set of investors, but also giving them access to the same set of opportunities that our institutions get access to. And that will either be through creating feeders the more traditional way, or we've spent a lot of time on creating individualized products that are more democratized, but sit side by side with other institutions. And then we take it from there. We've had our success over the last few years, but really our job is to help grow all 3 of those verticals. We do it hand in glove with those teams, and we do it in a way that brings value to our clients at the investor level. And we do a good job investing the capital, then it just sort of builds upon itself.
What learnings did you take from the LP's perspective of working with institutions to the wealth business?
The wealth business was started in the credit business when we were at Owl Rock. And one of the things I think that makes us quite unique is we started our wealth business when we started the business, period. So we went to both institutions and wealth simultaneously, which is very uncommon. Most people, you sort of start institutionally, and then you decide at some point maybe to get into the wealth space. If anything, we didn't make our way with the institutions and then switch. We've been doing it from the very beginning. I'd answer it slightly differently, which is what we wanted to do from the very beginning was tell all of our clients, because again, this is help for institutions as well, is you don't have to worry about where the assets are going and who has first priority and first claim. The learnings we had in talking to any investor is it's very simple if you just tell them your funds are designed as access points with different needs and structures and circumstances, but you're getting the same team, the same policies, procedures, opportunities. And so everybody's in it together. And that really helps a lot of the conversation we have with investors, really of any size, because they understand that treatment is equitable.
I think you're bringing up something so fascinating that I think is happening in this space, which is you're starting to see this product innovation, particularly on the wealth side, around things like evergreen products or semi-liquid products, different types of products that are really built for the wealth channel, but then you're seeing institutions want to use them in certain cases or in certain strategies because it makes sense for them to use them. How much do you think that the product innovation that you and your team can help create working with the wealth channel will actually loop back to all of your institutional clients?
Yeah, I mean, we're observing the same thing. So the product structure and innovation is critically important to the wealth space because at the end of the day, it's really around, to oversimplify it, is ease of use or client experience. And if you're in wealth, you're definitionally in the game of volume, significant volume. And importantly, the people that are buying the product tend to also be not just the investment decision maker, but also the operations person. It's not like you're dealing with a very large sovereign wealth fund or pension where they have teams of people to do it. And so that product structure has helped that. In addition, with the evergreen funds, and we were very early to this space, and one of the leaders in it, is removing the drawdown structure also simplifies it as well. All your money gets put to work, it gets deployed. And when you think about it, it's okay, well, I want to make a 5% allocation to real estate or 5% allocation to direct lending, and I don't want to have a lot of hassle over both making the investment and modifying and managing it over time. You can extend that to an individual or an institution. It's the same thing. It's people managing the capital. They're doing it in different ways. And we've definitely seen this, especially as these funds get bigger. Now, look, the very, very large institutions are unlikely to do this anytime soon. For managing a $500 million, billion endowment, you want to make a $15, $25 million allocation, it's just easier to use. It accomplishes your goal. The costs are in line with what you would expect. So we've been candidly surprised. It's not the initial setup, but it makes sense now. Ease of use matters to anybody, regardless of whose capital you're managing. And the ability to make an allocation and modify it over time in a way that meets your portfolio objectives, in a way that's cost efficient. Again, that's applicable everywhere. So I do think that trend is here. We've seen it, and I do think it'll continue.
Have you had to structure your team in a certain way, or even work with the investment side of the business at Blue Owl in a different way when you think about things like creating a better customer experience?
Yes, and the answer has evolved over time. What we think is really important is you have to strike a balance between the team that's out there deploying the capital and candidly the level of education up front and the level of service on an ongoing basis with the clients, because they will have questions as they're considering the investment, and they'll have questions after they make the investment. You just can't pull your PM off the desk all the time to be able to support that. It's easier when we were smaller and younger, where we could do that because there wasn't that many people and there were that many places to go. But as we've grown, we've definitely added resources in terms of people whose jobs are solely to make sure that there's that connectivity between the investment team and the sales team. And there's also technology on top of that. As your sales team grows, you have to be able to scale their knowledge base. And you can do that through technology. You can record videos, put things on internal websites, things like that, but it needs to be organized and thoughtful around that. But it's all around making sure that clients get answers. They get answers that are accurate, get answers that are consistent across the board. And certainly you have to evolve how you do that as you grow. And if you're not able to do that, clients figure that out pretty quickly.
How important on that point is the structure of your sales team or distribution team that's educating and then working with the wealth channel?
The structure is critical. They are the tip of the spear. They are the ones out there. Wealth is typically working with an advisor who's managing other people's money. So there's very little direct to consumer in the alt space, at least now. So we're typically talking with the financial advisor or the banker or the client advisor. The term is different depending on where you are in the world. So that team, that setup is really important because you need them to be very dangerous about your products, very dangerous about what's going on in the markets. They need to understand what the competitive landscape's doing, but they're on an island. The ones out in the field, they tend to be regionally based. And then you need a whole structure to support them, both follow-up, servicing. So the structure of the team is really, really important. It's got to fit within your organization, what resources you have, and also fit really who you're working with in terms of distributing through, because every wealth partner is slightly different and the way they want to work with you is slightly different. So you have to meet them where they want to be met as well.
And you're bringing up so many interesting points around the types of skill sets a salesperson needs to have. They need to understand the product. They need to understand the customer. Is there a specific type of background or skill set that makes for the best type of salespeople selling products in the alternative space?
I think there's a couple of common principles that we found to be very helpful. One, you have to be a self-starter. You have to be entrepreneurial. It's a hard job. You're out there. It's competitive. Most financial advisors spend less than half their time on investments generally. And how much of that is spent on alts is even less than that. You're fighting for mind share. You're going to get told no a lot. So you have to be tough and willing to do that. You need to be helpful to be a good people person. It's relationships. People want to do business with people they like. You have to be able to do that. You definitely need to have a level of enthusiasm for the markets and understanding the products and how they work and get excited about that. And then I think this one may sound obvious, but I think it's really important. You have to be very willing to deal with difficult situations and importantly, be honest, for lack of a better word, which is the natural tendency in sales is to tell people what they want to hear. You will get a sale short term, you will kill yourself and perhaps the business long term by following that. To me, the biggest thing when we're interviewing salespeople is trying to pressure test their level of honesty and really just kind of like the character behind that, because it's easy to sell when times are good. It's when times are tough when you really tell what the type of person is. So we spend a lot of time on that as well, because markets will go down, performance will stumble, things will happen that are outside of your control, and you have to be able to work through that. That's the most important part of the job, and candidly where you can differentiate relative to others in the market.
I think you're hitting on such an important point with the last comment, which is that this is not a transactional sale. Private markets are generally longer dated investments. It may take longer for them to realize their returns. The contours of those returns over time in that cycle may change, and therefore being upfront and honest about that is so important. How do you think about the fact that alternatives is such a consultative sale? It's not really as much of a brokered product in a sense as it is more understanding the client's needs, their portfolio. And maybe there's still gaps missing in the space of how do you understand all of that when you're saying, hey, this is why the Blue Owl product makes sense versus something else, or even a different. It could be like, hey, let's invest in something more liquid, like some sort of liquid credit index or a cat bond instead of a private credit instrument. So how do you think about all of that?
A huge amount of our success, I believe, is going in and not selling a fund or a product. That was pretty hard to do when we were just Owl Rock, because all we had was really one strategy. So it didn't matter what you want to talk about. We're talking about direct lending in that meeting. One of the real benefits of being at a diverse manager now and how we've created Blue Owl is it is a heck of a lot more effective, both for us and candidly more valuable for the client, which is why it's more effective for us, is to come in and just talk big picture. And the level of sophistication perhaps the wrong word, but just the familiarity or the understanding of the private markets will vary. But we'll go in and we'll say, look, private markets are a huge part of the universe. If you're not investing in it, you are likely doing your client a disservice because you're ignoring 90% of companies in the US are private, as an example. Here's the various ways that we work with them and can give you access to them. And then we'll tie it back to what they're invested in. So in your traditional 40, we have things that trade off daily liquidity for higher current income and less vol, and here's how it works. Our goal is to be consultative, educate them. It's a much better business because, one, we're adding value to the advisor if we're doing our jobs properly, and then two, if the advisor believes it, they'll allocate across their book rather than just try to think of their one friend at the country club, their one prospect. But it's more scalable as well. And then obviously, to your point earlier, there's a long horizon for these products. As long as we set expectations properly, we deliver on those expectations, we're there to answer questions. If you can get allocations across their book and we do well over time, it's just a much better business. We're adding value to them. We're getting a bigger piece of the pie. But it really starts with not trying to go in and just sell a fund or sell a product. You're trying to go in and add value. And then where that conversation leads will depend, of course, on the advisor and what's interesting to them.
You touched on something that takes my mind to the concept of these larger platforms like Blue Owl are effectively becoming these one-stop shops. An advisor can, like you say, allocate across their book and do different products, different times. How much do you think this space is evolving, particularly in the wealth channel and institutional as well, I think actually too, where firms like yours are becoming a one-stop shop, where you're a solutions provider and people are working with you across all sorts of products and strategies?
I definitely think that trend has begun and happening. I think it's early, but you saw this happen in the liquid space. There's a handful of very large managers that have a disproportionate amount of the capital, and they've earned it because they've done a good job. I certainly think in the private markets that trend has begun, and I do think that will continue. I think we will be part of that small group. I think it's twofold, though. It's the capabilities. So you have to have the capabilities and be credible. But I also think, again, the structure of the funds has also made it easier to do that. If you were coming out with your flagship fund once every 3 to 4 years, it's just not possible to constantly be relevant to the wealth channel. By having funds constantly available in market, you're more relevant to them and therefore able to continue to do that. But certainly, it's like anything else. If you do a very good job the first time, when you come out with a new idea, the second idea is a bit easier for them to understand and trust you. You're certainly seeing that in the wealth space, and we're benefiting from that. So my sense is there will be a handful or two of large managers who have diverse capabilities, will garner most of the AUM. We're starting to see that now. I think that'll continue. And for smaller managers, it'll have to be something very differentiated or more niche, or it'll just be harder because the scale will drive it more competitive, and it will not be dissimilar to the long only mutual fund space.
I want to get to the differences between the large scaled managers versus some of the smaller managers. I think there's a lot to talk about there. But before getting to that, you mentioned that the wealth channel is very different across client types, geographies. Let's just take the domestic space for now. So you have wires, you have RIAs, you have family offices, you have broker dealers. How do you think about working with each of those client types? What are the similarities? What are the differences?
We think that they're different enough, and difference may be not the right word, but we think that they have characteristics that are unique enough that for us warrant customized service. You look at the RIA family office space, just as an example, there's zero brokerage there. By definition, they are managing the money for a management fee. They already manage the assets. They're just trying to be good fiduciaries. And so more than anything, that is really focused on the value proposition within the overall portfolio. In addition, there tends to not be any barrier to entry. You can go and talk about anything you want. Or if you go into the office of a financial advisor at a broker dealer or a wirehouse, you're not allowed to technically talk to them about something that they haven't onboarded. And so right there's a huge difference. Some of them would get paid on brokerage, some of them don't allow advisory. And there's a gatekeeper here. It's much more competitive because there is no moat in terms of calling on them, but the sales cycle is much longer. So, we think about candidly each one of those markets. We tailor our teams, we tailor our messaging, we tailor our marketing. To a certain extent, we tailor our products to them. And we have over time increasingly customized to, put it simply, just meet them where they want to be met. That's something that we determine not all on our own. We spend time with them. We understand, where the holes are, what their needs are, and then we try to work backwards from there. And that's just in the U.S. It's the same thing outside the U.S. It's just a little more complicated.
Well, around product structures, around regulatory environments, around who the types of customers are. So I imagine, does that then also drive how you structure your teams differently in different parts of the world or for different channels that you're working with to, like you say, meet the demands and the needs of the client?
The sales team, for sure, they're channelized for the most part. It'll sound obvious, but local coverage needs local people who understand the market, speak the language to the extent it's not English, understand the landscape, and it's not a one size fits all. We ultimately structure the team to be very local, very tied into what's happening in their various jurisdictions, whether it's in the U.S. or outside the U.S., and the support model underneath it, things like operations, things like marketing, things like that kind of portfolio management support, that tends to be tailored as well to make sure that all of those various functions have the right level of support, which is in the right time zone. If you have a question in Hong Kong and you're serviced by New York, it's going to be hard to get an answer because everybody's asleep. Is it in the right language? You have to tailor the support underneath it to also match the sales team, because otherwise sales team is just going to be out on an island. It's going to be very ineffective.
It's interesting to think about, one, how you structure a sales team and all the supporting functions as well, all the way through to customer success. You mentioned customer experience too. My mind actually goes to the technology world. Obviously, startup world and software world has talked a lot about customer experience. Bain & Company put out a report late last year, I'm sure you probably read it, saying that the wealth distribution teams at large alts managers should think about this like enterprise software. One, how do you feel about that approach? And two, are there other industries that you've leaned on to learn from how they've structured their sales teams and sales efforts in terms of how you've thought about building the wealth solutions business at Blue Owl?
We're probably through a third or fourth iteration of how the sales team looks today from when we build it to where we are. We've had to consistently evolve it, in part because we've added new capabilities, which just adds complexity to the sales process, as well as new geographies, and then adding new partners that we work with. Just in the U.S. alone, over 300,000 advisors can buy a Blue Owl product. It's just such a huge number that that's not where we started. And so we've had to evolve it over time, and we'll look anywhere for help and answers. And I think that's partly of our success is we've never picked one thing and just try to keep jamming it, through the system. I think enterprise software makes a lot of sense. We've spent a lot of time, looking at what the long only space does. It is a much more competitive market there because the products are viewed as more commoditized, rightly or wrongly, than alts are, at least today, which means they're selling either using more data, more consultation, more focused on marketing, like true marketing, not like salespeople. And there's other areas that we're looking at, and we're constantly looking for ways to be more relevant and more in front of clients. The hardest thing for us to do, candidly, is to get a meeting. Once we get a meeting, we can pretty clearly articulate our value proposition and we have high success. Getting the meeting tends to be the hardest thing. And so wherever we can improve our chances there, we're certainly all ears to ideas.
Why is it so hard to get a meeting?
I think it's so hard to get a meeting just because everyone's trying to get a meeting. I was meeting with a very large financial advisor just last week down in Miami, and he shared with me, he goes, I spend 80% of my time just trying to go get new clients, 80% of his time. So that means he spends 20% of his time doing everything else. Let's say all 20% is focused on investments, and let's say 10% of his portfolio is in alternatives, private markets. You're fighting for 2% of his time. It's just mind share. These advisors that you call on, they're running businesses. They're trying to get new clients. And there's plenty of blue owls trying to call them. And then there's the long only shops trying to call them. And then there's insurance companies and all the service providers. They get inundated. So it's very easy to get drowned out in all that noise. Trying to figure out ways to stand out is a big part of the effort.
It's kind of funny because we were joking before we got on the podcast about the studio that you have at Blue Owl. And then obviously you've done a ton of work and on social media. I think a number of great pieces on Twitter, et cetera. What do you think about the next wave of brand awareness? And how do you think about doing that as a way to get in front of people?
Please be sure to like and subscribe and meet us on all the various channels. If you ask anybody around here who's been at the firm for a while, none of us thought we'd have a studio to think about that. And beyond the studio, everything we record now is translated into 6, 7, 8 languages, and it's broadcast around the world. And the amount of people that view it and consume it, it's pretty remarkable. I think it's a function of one, we have pretty interesting insights given all the various pieces of the business and what we can see, and we hope to share that and add value. I'd say that's definitely going to be a core pillar that we continue to build upon, which is sharing our insights because people have found them valuable. They want to hear from us. The second piece of that is general brand awareness. We do lots of different things around that. A lot of our partners have events that we can go sponsor and participate at. We will do our own proprietary events around education. We're looking into traditional branding as potentially things that we could do to help raise awareness. I think our logo, the owl, is pretty cool. It looks good on swag. And so there's lots of different kind of areas where we're trying to build that awareness because it matters. It matters a lot.
Does this mean that a Super Bowl ad might be on the horizon?
I think we're going to leg into it. Super Bowl will be a little ways to go, but maybe one day you'll have the owl somewhere on the field.
I joke about that in a sense, but there's actually some serious undertones to all of this. You look at what Blackstone did with their Eras video, which was they're paying homage to Taylor Swift. You probably can't get more mainstream pop culture than that. I think it's fascinating to see the consumerization of private markets in a sense from a branding perspective. How do you think about that as being part of this next wave of private markets as you work with the Wealth Channel?
Look, I think brand awareness is critical. I think candidly, we've had a lot of success, but it's been despite a lack of any brand awareness. Just to call it out, we rebranded everything as Blue Owl in the summer of 23. It was 6-7 months ago from today. And it was just very confusing for lots of our clients. Blue Owl was the public company. We had an Owl Rock, we had a Dial, we had an Oak Street. And even beyond that, a lot of those brands were newer to the wealth space just because of the relative youth of our business. Like anything in consumer facing, if they're not familiar with it, they're unlikely to give it any time. I do think there's an element of needing to raise awareness of who we are, our credibility, our capabilities. People tend to invest and consume things that they trust and know. I think it's a balance striking exercise there. I do think you can go too far. We're certainly in the early days where I don't think we're at risk of that. But certainly I do think that'll be helpful as we try to convert. The biggest opportunity in wealth is not to try to compete against everybody. It's really to grow the pie. Part of the reason everyone's so focused on this and excited about it, rightly so, is penetration is extraordinarily low. And there's lots of reasons for that. But one of them that would help is if people were more familiar and more comfortable, the pie would grow. So I do think that will be one component of the solution there.
Well, that gets into education, right? If you think about education, that helps everyone understand the market better. And then ultimately people will pick what products they want to invest in. But that's because of an understanding of the market. How do you think about educating the wealth channel on alts?
This is critical. A lot of us are focused on this. And when I say us, it's our peers, but it's also the platforms we work with. It's a common goal when we talk to the vast majority of our clients that we work with at the very top of the house. They view it as an imperative because it's worked for institutional clients. It's worked for wealth clients who've adopted it. It's improved portfolio experiences. And it's the level of penetration, though, continues to be stubbornly low. And one of the major impediments is people don't understand it, not familiar with it. And so education will help, break down some of those barriers and grow that pie. We think about it in a variety of different ways. Obviously, we can do it through brute force, our boots on the ground, talking to them one by one. That's one element. We talked about our marketing capabilities in terms of the white papers we're putting out, the content, the videos. That's helpful. We'll do our own proprietary events where people will come and do a deeper dive with our management team, going through all the strategies and case studies and portfolio companies. We partner with lots of different participants in the market. Some of them are peers, where we do events together. So we're not just pitching you Blue Owl. It's hear from a couple of different managers with different capabilities. We'll partner with our partners themselves, the wealth management platforms, other providers in the space. We have a whole curriculum and track that is really designed to do that. And then we've more recently customized it to the extent we know sort of where you are in your path. So if you're already very familiar with alts, but maybe it's just private real estate and you haven't looked at private credit, we're picking up from not 101, but 201. But if you're just in the 60-40, we know we're starting at 101, and we tailor that messaging to them there. So big effort. It's hugely additive to the whole industry. One of the biggest opportunities for all of us.
What do you think is still missing from the education of the wealth space about alts?
With so many people now coming into the wealth space, we've been in it for a while. There's been a whole bunch of new entrants the last 2 or 3 years. The level of education has ramped up to an extraordinarily high level. And it's hard to figure out where to start. And it's all very manager specific. I do think a more concerted effort, I don't know who should take the lead of this, probably us and a few others, but trying to really centralize the education and make it less manager specific and more kind of industry specific. I think it would help everybody grow the pie. We can share our insights, but we're sharing our insights from our perch and our peers are sharing it from their perch. I do think it's created a fire hose of information where it can be a bit overwhelming. I'm sure some folks will figure that out. We've been spending some time on it, but that to me is one area where I do think that the space can improve.
How much do you look at some of the prior product innovations, ETFs being one of them, what BlackRock did with iShares once they bought BGI, and then others in the ETF space, and then the mutual funds, the SMAs? How much do you look to those product innovations as sounding boards for how you think about building educational programs, content, and success in working with the wealth channel with alts?
That is a very big part of how we do it. We have a handful of people here that were part of some of those innovations and have lived through that. It's interesting to hear their perspective. My whole career, as we talked about earlier, is through the private market. So I've never lived through that. I don't know it, but we've got folks here who've never been in the alt space, but have been in some of those other areas. And that's by design because we want to learn from that and have diversity of views and insights here. Many of them view it as strikingly similar to some of those innovations that you've seen. And they're bringing different practices to how we go about organizing our sales team, going to market, creating our content. And so I do think, as we talked about this consolidation and growth in the market, it's not the first time it's happened. So it's logical to look back and see who's done it successfully and what you can take and apply to the alt space.
How do you think about the entrance of the more traditional managers getting more into alts? BlackRock acquired GIP recently as an example. On the infrastructure side, Franklin acquired Lexington Partners. How do you think about the entrance of the traditional players into the alt space as you think about building and growing Blue Owl?
On the one hand, and not to be dismissive of it at all, it's been really hard. I think for them, the strategic rationale is pretty simple. It's new high quality capability, which all those firms are, plugged into world-class distribution, which is what those firms have. It's just not that simple. And I think they've all learned that the hard way, that it's become increasingly difficult to make that 1 + 1 = 3. And there's a big cultural shift there around how those products are distributed and sold and plugging them in. Smart firms with lots of resources, I'm sure they'll figure it out over time. But it's been very, very hard. And I think it's proven that it's very difficult to just say, okay, well, I can sell this thing. I can now sell the other thing. It's much more complicated than that. On the other hand, I think, look, like I said, they're big firms with lots of resources, lots of brand recognition, lots of capabilities. And so it makes logical sense why they're entering the market. I think some of them will start to figure it out. A lot of feedback I've heard is our clients really respect those firms for what they're known for and what they're good at. This isn't one of those things. So there's an education process they're going to have to do as to why I'm all of a sudden good at something that's more locked up capital when I'd never thought of you like that before. I think that's also one of the challenges there. Something we're definitely focused on. It's been harder, I think, for them to make it happen, but you never want to take your eye off competition, and they're very large, credible firms that we need to be mindful of.
Not to necessarily give advice to your competitors or certainly share any of your secret sauce, but what advice would you give to firms, either traditional or smaller alternative asset managers who are a click smaller than the likes of Blue Owl, if they were going to start a wealth business and have a team dedicated and focused on this space?
I think the biggest piece of advice I would give is, and actually the stakes have only gotten higher. It's really hard to dip your toe into this business. You can dip your toe into the institutional business. You hire one person, the number of clients is known. Maybe you can't call all of them, but you're not going to really lose out other than just opportunity cost. In wealth, if you're not invested to a bare minimum level, which is usually much higher than you think, you're throwing good money after bad. So I do think that that's a mistake firms have made over the years or continue to make now, which is to be able to get that message out, to broadly distribute, to support. You need a certain amount of bodies, you need a certain amount of technology. It's going to cost you a lot up front. It's going to take you a long time to see that pay out. But if you're not willing to make that upfront investment, you're almost better off not throwing the money away.
Is the talent there? You say you need bodies to be able to build and staff these teams. Has there been enough time of enough people working with the wealth channel, selling alts products into this channel, that there are those bodies to build and staff teams with?
I think there are. The market, of course, has gotten way more competitive in terms of recruiting, just all of the entrants that have come into the market. They may not have the direct experience of selling private markets to financial advisors. You may not be able to get one for one, but there's lots of very capable, very sharp, very smart salespeople selling complicated products to them. Structured notes, insurance contracts, things like that are not your stocks and bonds and ETFs. And so there's a pretty deep bench of those groups. They don't all translate over, just to be clear. You have to get that right, and that's not an easy thing to do. But I do think that the talent pool is big enough at the moment where you can get quality people. But it was easier 5 years ago than it is today, for sure.
I think what we're getting at is the broader theme of many of these alternative asset managers looking to wealth to grow their business because it actually is good business. There's a number of examples of this. Your team talked about this at the Goldman Sachs Financial Services Conference in late 23, of that you'd look to acquire franchises that can produce high current income, downside protection, obviously additive to the core work that you do at Blue Owl. How much do you think the wealth channel, whether it's a firm that already has inroads into that channel and client relationships there, or the ability to then take those products and work with the wealth channel with the platform and infrastructure you've already built, how much would that factor into any acquisition decision you might make?
It's a big factor as we look at strategic things that we can do at the Blue Owl level. Not in every case, but in many of the cases, we look to where we can buy something and grow it. Our acquisitions, we've done very few, but where we've done it, the idea is not to rationalize cost and squeeze more margin out of it. It's here's a really great capability. It fits well within that current income downside protection capabilities suite. Great team. Plug them into our infrastructure and we can scale them much faster than they could do it on their own. Our real estate business is the perfect example of that. Team, great track record, differentiated capability. They had a little bit of inroads into wealth, and then we turbocharged it. And it's been great. We added a new product. They have distribution everywhere globally. The fund is scaling even in a difficult real estate environment. And that's the blueprint for what we would like to do, which is if we have something that is big total addressable market, consistent with Blue Owl, and we think we can scale it, we're going to be a great partner. Given the focus on wealth, what we're finding is a lot of those managers want to get into wealth and are saying, all right, well, I'm not going to spend that $25 million or whatever it is to build it myself. I'd much rather partner with Blue Owl. So to a certain extent, it's helping us generate ideas on what we're looking to do.
what you're getting at, which is so interesting when you think about the evolution of the alternatives industry, is from a business building perspective, particularly for larger platforms, this is an imperative. This isn't one of the things on the list. This might be the thing on the list.
The market has made that very clear over the last several years. There's that software that tracks how many times you say retail in the earnings calls. I don't know if I've ever seen that, but it's no secret. Many of our peers have made acquisitions into the space or made it very public that they are building, talking about the products they're building, the teams that they have, their initiatives. And if you don't, it's viewed as your business is not in a meaningful channel. And there's some serious questions as to why not.
I think you covered that so well. Today's podcast is a fascinating conversation. I always like closing with something a bit more personal, which is, what is your favorite or most interesting alternative investment?
Gosh, you're asking me to pick which kid I like the best. This is a really dangerous question.
And you have at least three.
Yeah, exactly. I get really excited at the moment about our net lease strategy. I think it is very early in its back to education. Of all the things we have, I think it's the one that's the most misunderstood, in part because of how difficult the real estate environment is today. It is a difficult environment for many real estate. But that one, I think it'll be a case study a couple of years from now in the value of education, the amount of hard work it takes to get that out in wealth. But it's very different from what really most people consider real estate, what our peers are doing, and what's allowed us to build an inroad into most people would consider an extremely competitive space, because it is, and to build a really big business in wealth. Yeah, twist my arm, that would be my answer. But again, I love all my children equally.
Well, what's great about that answer too, though, is it sounds like investing in education could be such a great investment for the alt space. That's obviously been talked about before, but it sounds like from listening to you, that's still the case.
For sure. I use the word triple net lease as if everybody knows what it is, but you go and survey everyone in the world, not many people do. And so we have to educate, what is real estate? What is net lease? How is it different than gross lease? We've had to learn a lot in terms of educating people around that strategy. And what does it mean in your portfolio? How does it operate in a difficult environment with rates moving? All the challenges have been there, and we've had some initial success. And I think we're poised to continue that.
Well, you've certainly educated us on the world of wealth today. So thank you, Sean, for coming on the Alt Goes Mainstream podcast. It's a fantastic conversation, and I think people will love hearing it.
My pleasure. Thank you for having me.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going